So we'll take you through real examples of two clients. The first one is Sentum. We actually have a Sentum representative. I'm glad to say hi. Yes, from the finance team. And we'll take you through another second example, which is of an insurance company that we've managed since 2016. So these examples are from 2016 to 2025. And they'll touch on three things that have been reiterated quite a lot. The challenge that you face: liquidity, safety, and yield. I think a lot from the surveys that have been done, the challenges are mainly liquidity, safety, and yield. I think on the safety side, it seems that that's pretty much covered, but now we'll talk a lot about yield, the return, and how important it is for every type of organization, not just limited to the financial services company like Sentum or an insurance company, but touches on every sector that is here: hospitality, energy, tech. Which other sector do we have? Medical. Which other sector? We have SACCOs. Which other one? NGOs. Okay. I won't belabor this point, but when cash is king, control is the crown. So you have to be aware of cash being king, but beyond that is that you have to take control of your finances completely, from the point you receive your cash flow to how it's invested to now when you go through that conversion cycle. And cash will forever remain king. And this is a context of why this is important now when we look at those case studies. If we look at the liquidity challenge, so we have four things: liquidity challenge, an investment solution for that, a strategic approach to look at that, and maybe an advantage that we as a fund manager can offer an investor. So the liquidity challenge that we're saying is you're trying to balance your operational needs with your long-term growth. So you have this thing that is pending for tomorrow, for next week, but at the same time you have a strategic mindset or plan that you need to achieve in the next 1 year, in the next 5 years, in the next 10 years. So how do you balance that? The next thing is maintaining such sufficient reserves for any unexpected opportunities or challenges. Opportunities and challenges, we'll talk through that. An example was COVID, and we'll take you through how our client was able to navigate through that and adjust their portfolio rightly to meet that. And also, this has been talked about quite a lot: avoiding idle cash, so you don't erode your value through inflation. So inflation, who knows the inflation rate currently? Yeah? Yeah, 4.5. Another attempt? Okay, yeah, 4.6 actually, but we're there. So inflation moves in cycle. Right now we're at a low inflation point. 2 years ago, we were around 11%. A decade ago, we were as high as 22%. In 2015 and in 2011, we had our highest inflation rate. And so think about it. If you are allocating funds at, say, 7% in deposit, that's what you're likely getting. So how does that reflect on inflation? And lastly, is also meeting any regulatory capital requirements you might need. For some of you, there's need for that, like SACCOs. And then let's look at the strategic approach. You need to look at it from three structures when you look at your liquidity: immediate, short-term, and medium term. So your immediate is, what am I going to do next week? What am I going to do next month? How am I going to meet those operational requirements? Then you go to your short term, within the next 6 months to 1 year. And then you look at your medium term, your 2 to 5 year. So you need to have an understanding of where your liquidity meets that. And then the next thing is your asset liability matching to align with your cash flow forecasts. So you're matching what's coming in. Basically, your assets is what brings in money, and your liability is what takes out money. So are you able to match that For example, Maureen took us through what we do as Nabo. We're able to match the money that were paid out by clients to meet our expenses, say rent, employee expenses. So how well are you good at matching that? And then the third thing that Pius has really emphasized is diversification. This is across instruments. So instead of having all your money in a current account, in your bank account, are you able to look at other potential opportunities? Also, are you able to look at opportunities in different time span? So not just like, I'll have this current account for 3 months and that will be sufficient, or current or fixed deposit for 6 months. But can you think in 2 years' time, in 5 years' time, what instruments meet that? And also beyond that, if you can, don't be overly concentrated in one geography. There are 2 countries that collapsed between 2020 and 2024 in Africa. Who might know those names? I'll give you one example, Ghana. Then the second one, any? Okay. Starts with a Z. Okay, Zimbabwe. Another one? Zambia. Yes, Zambia. So those countries were unable to pay their debt. So you buy your bond as a bondholder. You think that is the safest investment. And then they were unable to pay their local investors, pay you and I, pay the companies, and pay international investors. And right now they're going through that recovery. So imagine Kenya, for example, failing to pay its debt. And it's not a long time ago that Kenya was seen as not paying its debt. Just 2 years ago, when everyone thought we'll default on our debt. It was a real problem. Okay? And lastly is regularly rebalancing. So you always need to change your views. So you can't be stuck and say, okay, I've invested in a money market fund, now I'm good. I've invested in a deposit, now I'm good. I've diversified that. But constantly when market conditions require, you need to adjust that. And even organizational needs, your policy might change. Your strategic objective might change. So how do you adapt to that? An investment solution, I'll go through this quickly so we go through the examples, so given that now you have a context. The investment solution, money market, for example, for daily liquidity, government securities can be considered, but also if you look at fixed income funds, which is a consolidation of all this. Corporate bonds can be considered to enhance yield when you're looking at managing that credit risk. And lastly is equity exposure, but this one is more so for, and you'll see for our client, equities is basically investment in shares. Who's invested in the equity market? Who's invested in the NSE? Hands up. Currently or never? Okay, who has never invested in the stock market in Kenya? Never. Who has never invested? Yeah, like Safaricom shares. So they're really good for long-term capital appreciation, and you'll see the advantage on that. And one of the things that we do for our clients, and you'll see that in detail, is the fact that we support them to construct portfolios that are aligned with their IPS. Your IPS is your investment policy statement. It's basically your constitution. How do you invest? And my colleague will take us through that later in the afternoon around how you construct your IPS. Your second thing is how do you access institutional grade investment vehicles? There are certain investment opportunities that you are not fully aware of. They're not being shown in the newspapers. They're not being shown, they're only being shown or being discussed by institutional investors. So how do you get access to that? And a fund manager is a good example of getting access to opportunities that you might not be aware of completely. Third thing is real-time liquidity management and reporting. Again, can you be able to outsource that liquidity management to someone who will report to you real-time and provide the reporting requirements that you need? And lastly is sort of experience. And hence, we outsource a lot of things if you look at different organizations. How many of you outsource HR for your organization? Okay. Does anyone outsource anything? Catering. Who outsources catering? Okay. Yes. So imagine something as, can I say minor or important, depending on how much you love your food, as catering. Someone who can be able to provide adequately for your return requirements, for your capital growth, as well as your liquidity. And not just looking at one investment space, which is Kenya, for example, but looking at Africa and other opportunities. So that's hence an advantage of a fund manager. So we look at, this is an example of Sentum. And they've gone through periods. And I want you to focus your eyes on the left chart. So when we started investing with them, this is a 10-year snapshot, 2015 to 2025. They started out with 4 billion shillings. Over that period, they invested 22 billion shillings. Of that, we were able to generate for them a return of 4.45 billion shillings. What does that relate to in terms of a return or a percentage? That's 14.47, or if I round that off to 14.5% per annum for 10 years, which is incredible given the cycle we've had. We've had COVID, we've had bank collapse in 2015, Imperial, Chase Bank. We've had Russia, Ukraine. We've had political uncertainties. We've had collapses of different institutions within Kenya. And we're able to still generate 14.5%. And I'll tell you how we were able to do this. And then they withdrawn. Because this is not a static, it's a business that has needs. It has operational needs, it has strategic needs that they require. They have project needs. They also have to pay fees and taxes, of course. And so over time, that's the cycle that has gone through. So how have the inflows come in? So the inflows have come from sale of assets. So Pius gave you an example. They're able to sell their UAP asset about a decade ago. And part of that, also the funds have come in from funds they've been able to raise, and also through their normal business operations. And what have they needed their funds for? Capital investments, very important, and you can relate to some of these things. You need to invest in capital, invest for CapEx, invest for OpEx, so meeting some of their monthly operating expenses, and also managing their debt obligations. So it's a mix of all that we've been able to support them through this portfolio. And instead of those funds lying idle, they could have easily put this 4 billion plus 22 billion, that's 26 billion, in any bank, a tier 1 bank. They could have put it in Stanchart, they could have put it in KCB, Equity, and they could have most likely, given inflation and how the returns and the return expectations over the last decade, which on average is somewhere around 5-6%, they could have earned 5 to 6% instead of 14.5%. But what we were able to do for them is we deployed these funds that they had, and as per the IPS, so this client, IPS is robust. So it met the needs that they had. What was their needs? They needed some funds for liquidity, but not so much because they already had their own funds that they could easily meet the monthly operating expenses. But what they needed earlier on in their cycle was they needed to grow these funds. And how can we grow it as fast as possible while ensuring that we minimize risk? So that was the agenda. How can we grow this fast, minimize risk, and most importantly, preserve capital? preserve capital. Give me at least, over these years, give me at least what I've given you. And we were able to do that. And we invested across different markets. Kenya, the home country. We invested in Ghana when Ghana was doing fantastically well. It only had issues from 2022 after COVID and the Russia-Ukraine war. We're able to invest in Uganda, Tanzania, Nigeria, Egypt, Morocco, and even USD assets. When investing in USD wasn't popular, it's when you invest in USD was just for export companies that earn dollars. But that's not restricted. They might not have been earning dollars at this particular time, but we still invested given the opportunities that we saw. And what we're able to do is optimize the yield and ensure that they had a diverse exposure to currency. And why currency is so important, and we've seen it, is that, for example, Nigeria and even Egypt, over time, the currency has depreciated, meaning that it's not collapsed, but it's lost value, but almost double over time. So you have to be also strategic in terms of how do you, when you oversee these things. So our manager is able to do this even much better because we see this on a daily. We talk to stakeholders who are based in Nigeria or Egypt, and they say, for example, Egypt, they were saying at that time before the currency collapses, you go to the market and you go to your bank and they tell you there's no dollars and you're an export, you're a importing company. And so what used to happen in Egypt, there was a black market currency. So people will actually take money from the bank, their local currency in pounds, which is the Egyptian pounds. And then what they will do is you take cash, you go to a local vendor on the streets. So you take, for example, 10 million shillings, and you do the same and you convert. So the official rate will be, let's say, $1 is 20 Egyptian pounds. People are willing to do it for double. So you will lose double of that value, but just to get the dollars. And we saw the same thing in Kenya. So it's not something too foreign. We saw that in 2023 for the export companies that have experienced that, for the individuals who tried to convert. And that's where we saw the shilling move from about 120 all the way to 160, even almost close to 170. And so that occurs. And to note what this portfolio reflects, importantly, is one, disciplined liquidity management. So it's very important for us not just to have contributed to the return, but also how would we have funded that 28.6 billion that was really needed by the organization to meet the capital needs, their OPEX and CAPEX, and also to ensure their growth, their flexibility, and to ensure resilience across different cycles, okay? And so this is a picture of how things started, how things are currently, and how things changed. So the headline numbers, 14.5. Investment income generated, 4.5. Diversification, 7 countries. So when Sentum started, when we started the portfolio, heavily on equities, 70%. As I said, what was the agenda? We need growth. We don't need to pay any OPEX. The CAPEX solutions are in-house. Just give us growth. And that's what we did. We allocated 70% to equities. Then, you can't fully allocate to equities because you need some buffer in terms of medium risk, because you're in the high risk category. So you're high risk, high return, which is equities. So if you want high risk, high return, you go to equities. When you want some low risk, you go to government bonds because that's risk free. It's the lowest risk you can get in any investment. So we put 20% there. And then we put 10% into corporate bonds. You've heard, for example, ABL are listing their bond for 11.8%. They listed it, our about 5 years ago of somewhere around 12.5 to 13%. So the interest rates are coming down. So corporates take advantage of raising funds from me and you and corporates, and they give fairly good return. So if you're getting 11.8% from ABL for a treasury bond of the same tenor, you're likely to get somewhere around 9 or 10%. So you're getting a spread of 1 to 2% typically. So that was the start. But as I've said, you have to evolve over time. So you might be comfortable with that, but things change. What changed? We come to 2020. And equities weren't doing so well, right? Some of those markets were having issues. I've mentioned Nigeria, I've mentioned Egypt, they were having issues. Ghana at that time was tilting towards looking like they were having issues because their Eurobond, which is a bond raised by a country in dollars, they were around 6%. In 2020, the Eurobonds in Ghana were the highest, perhaps in the world. They were at 20%. So you're going from 6% that you're paying debt to around 20%. So what does that tell you? For some, it might tell you, I can get some returns there because I'm earning 5, why not invest? If I'm earning 6% with Kenya, as an investment manager, you'll be like, so I can go easily to Ghana and earn 20%. But there's a reason why each rate is higher. And that's a question I'll also leave you pondering and mulling over, is that when a return is higher than, say, even a country, you look at Kenya at that time, 7%, Ghana 20%, ask yourself why. Because the return is a factor of demand and supply, right? What we learned in school, demand and supply, economics 101. So the supply was higher, the demand was lower, so the price went up. So that's an example, so the yield went up. So the investors were perceiving that Ghana might collapse. There's a chance. Even Kenya's yields went out as high as 22%. And we were able to buy for this portfolio. Some people thought we were mad. And I remember talking to a broker and was like, I'm going to, and getting approvals. And I was like, at that time I was trading and I was saying, okay, let's buy this. It's like a buy. We buy it at 22%. And my conviction was that given Kenya, and I was comparing Kenya, Ghana, and Zambia, I looked at the dynamics of where Kenya was, and we looked, from a macro perspective, we looked much better. There were things that we were struggling with, especially when it came to our debt, but it wasn't as high. Ghana's debt to GDP was over 70%. Zambia was over 100%, so they owed more money than they will make from their GDP. Kenya's was around 68%. And also, another thing that we had that the other two countries didn't have was IMF support. So IMF was on our necks, telling the Kenya government each quarter, you have to do this and this and this. They couldn't meet all of them. They met some of them, and that's why we've seen tax hikes for some of it. And that's why we had the financial last year with the Gen Z, because there was a push for taxes to go higher. But people can only take enough so much, and that's why we had the Gen Z row. But it was good in terms of meeting those payment requirements. And then, hence, we bought Kenya at 22%. And something to note, or something to learn today, is the difference between yield and price. So when you're buying a bond at, say, a higher yield, say, for example, the Kenya bond that we bought at 22%, the price will, say, be at 80. So when the yield came down to 10% in like a year's time, so we made a profit from 80 to maybe 95. So that 95 minus 80, that 15 shillings was our profit. And it's compounded when you have a 20 billion portfolio, significant amount of money. And even from a return perspective, that's over 30% return. For this client, it is even the news, we made over 33% in 1 year. And that was just based on Eurobonds and our conviction on that, that will happen. And we've seen sort of the results around that. Yeah. Oh, okay.
No,
Question?
No, in my head I'm thinking, is this behavioral finance? Somehow It's your instincts, your gut telling you where we're putting the money.
Yeah. So that's a good question.
But there is a bit of behavioral
There is.
going on.
There is. That's a really good question. It's a mix of gut.
Yeah.
So you do your research, because all of us are doing our research. All these investment managers are doing their research, but some are very convicted. Some will tell me Kenya is going to default. Utapoteza pesa yenyu. Even a broker will be like, hey, you're buying that? I'm not sure. You know, Kenya, I've been looking at the news. But now you get that gut, plus you back that now with research and understanding the dynamics. So, but also we recommended to other clients the same. So it wasn't just Sentum. We recommended to others, and they were like, yeah, we hear. And they lost out on the opportunity because they could action it, but they were, let's wait and see. So sometimes what I've learned through investing during high-risk markets, like during COVID, is the fact that sometimes you're better off dipping sometimes your toes in it, yeah, and getting some exposure, right? Because sometimes it could be, it's like, for example, let me use crypto. All of us have had crypto 10 years ago. Everyone knew what Bitcoin was 10 years ago, 2015. And at that time, it was around $10,000. It's 10x that. And I'm always thinking, what if someone was like, I have 100,000 shillings, my total savings. Wacha nieke 10,000. Let me put 10K. Na nisahau. Ikipotea, imepotea. And for those people who are able to do that, they saw that growth in their fund. So it's always good also, especially when you're given some guidance to evaluate it internally, but also take that step. So I encourage us to take that step. Yes?
I have a question.
Yeah.
So do you also invest in junk bonds and anything of that sort of thing?
Yeah. Interesting enough, Kenya was a junk bond at that time. Yeah. So junk bond, what he's asking is there is credit rating of different countries. Okay. So I'll accelerate because some stomachs are grumbling. So yeah. So what I was giving the example is junk bonds are if there is credit rating. So Kenya, for example, at that time had moved from B to almost triple C. So the lower you go, you start with A. Who are the A's? The US, the Switzerland, the Japan. Then the B's, so you have the kind of the B's. The top B, so there's triple B, and then there is B, there's double B, and B. So the triple A's are the US, the double A's are like, let's say like France, single A, say like China. And then now you have your triple B, the highest triple B in in Africa, the sort of most rated country in Africa, the top tier African country is Morocco. So that's really, that's like the top African country. It even beats South Africa, it beats Nigeria. And then now you have another country which has done so well is Ivory Coast. It's really up there when it comes to ratings. And then now you have Kenya at B. But then the rating agency was like, hey, you guys by default, we're not too sure. They moved us to triple C. So anything, especially triple C and below, is junk bond. So we're able to invest some of that, but not all of them, like Ghana, for example, or Zambia. Yeah. And so let me complete this because of that time. And so we moved more towards bonds to take advantage of those opportunities, less towards equities because they weren't doing so well. We still had some exposure because some countries, despite COVID, were doing well. This is where the American rally actually started. If you look at 2020, if you look at chart in US, between 2020 March and to 2025, so you see a chart that goes like, it was this way, it was up, then COVID is announced and shut down, it goes down for 2 months, then all of a sudden, all the chart just goes up. So if you they call it like parabolic. So it goes up, then down. So if you look at the chart, since if someone put all their money, for example, a significant money in US markets, for example, you will have had some pain in COVID. But since June 2020, all the way to now, which is November, you'll have just been up. And so that gives you an example. And then now what happens currently, as we wind up, is that the shift has changed. So with allocation, equities has reduced, government bonds has reduced, but now there's more shift towards corporate. So corporate is a middle ground between low risk and high risk. So it's medium. So the entity has become more of a medium risk entity compared to a low risk, because they still want growth, but they still want to fund. So I've already spoken about this. Yeah, and so just to wind up, so what's key? We're going from a growth phase, defensive phase, to balance phase. So we went through that cycle. They were growing, they had a long-term horizon, very high risk tolerance, and they wanted to maximize growth. And this was on the context of new funding cycle and minimal immediate cash needs. So how that changed, went to a more defensive strategy with a focus around Kenya, and especially we reduced our equity exposure, we increased cash, and we allocated actually even to USD opportunities at that time, even through our money market fund. And this was on the back of COVID-19, which was quite uncertain. And also the entity was paying some debt repayments. So they needed also liquidity on the back of the cash. And hence you can see a high cash. So from 10% to 25%. And what's their aim? Preserve capital and also ensure liquidity for debt service. And now where we are, we're in 2024. It's more of a balance phase, as I've said, medium. So the 52% in different investments within Kenya and East Africa. Equities still maintained for that growth, and we've seen good growth. Last year, NSE performed 34%. This year, NSE is up over 42%. So the stock market has been booming, and we benefited from that through the investment in the funds, especially our equity fund, which we invest directly for them. And then what's the rationale? This is to balance yield, to balance your safety and liquidity, and to ensure also continuous debt repayments, and as well as meeting needs that might require, especially on OPEX and some level of CAPEX. And the context, as I've mentioned, is debt repayment, which stable funding, so it becomes a center for funding. So whenever we need X amount in this month to meet Y needs, we're able to provide that. But also we do not forget about growth. So not only are you meeting your needs, because I think where we are stuck in from the survey I've seen is we're just stuck in meeting needs. We're not sort of balanced. We're more like fully defensive, and you can see it's defensive but still growing. So can we look at or think about how can you still remain defensive, especially if your sector or your organization requires you to be stable, but at the same time, you're growing and you're becoming, you're adding value in that way. So that was what I wanted to present in regard to that. And I think the key lesson, and as you finalize here, is if you look at your investment strategy, one, you must align with your organizational life cycle. So each organization is different. Not every organization is Sentum. So you have your different needs. You understand your sector better than anyone. So how do you meet that life cycle over time? You also have to understand your funding needs. So how do you still meet your OPEX, your operational expenses? How do you meet your capital expenses over time and ensure that you're doing your basic duty or your basic responsibility? And also another thing is understanding your risk tolerance. So Sentum moved from high risk tolerance, very high risk. Some of us are very high risk. You can put all your money in crypto and you'll be fine and sleep well For some of you, you can put 1,000 in crypto and you'll sleep. You'll go crazy. So an organization is similar to that way. So for some of us, you need to understand what's your organizational risk tolerance. It might not be clear, and hence we'll talk a bit of IPS so you understand what risk tolerance is all about. So you need to understand that and adjust that with the needs that come. And so ensure you do not have a static allocation. So let's not, if we looked at your finance book 10 years ago, in 2015, maybe you can reflect on this as you eat. Does it look, will someone be like, if you removed the years and someone looked at your balance sheet, will someone say it looks exactly the same? Your allocation looks exactly the same. That there is no change. You haven't had a phase. You haven't had your growth phase. You haven't had your defensive phase. You haven't had your balance phase. It's just been the same thing, the same allocations, the same deployment, the same deployment, the same strategy. So hence, this is just a challenge to everyone in terms of when you look at your portfolio, understand your risk tolerance, understand your organizational life cycle, understand your funding needs, and also, key, understand your growth needs. So you can be able to evolve over time and generate sufficient return for your investors, for your funds, for your stakeholders. So with that, I'll end it there so I don't waste too much time. And thank you.
Thank you, Charles. Was that useful? Yes. You know, the reason why we are partnering with Ronald is because this is our bread and butter, and you don't want someone to come and tell you theories. Yeah? We've lost money, we've made money. You don't have to make the same mistakes we made, isn't it? Eh? Yeah. We can tell you where to pass. A couple of years ago, we made a very interesting observation. Insurance companies don't make money from underwriting. Yeah? Even the biggest insurance companies, they make underwriting losses. So the question is, how do insurance companies survive? Investment, isn't it? Eh? So, how insurance companies make money, they receive your premiums, isn't it? Eh? They invest the premiums, and then they pay claims. Yeah? So, the best investment companies and the largest investment companies have one thing in common. Yeah? They have an investment team that backs them up. It's not the underwriting business that keeps them afloat. It is the investment team that backs them up, that keeps them alive. And when they make investment income, they are able to come to you and I and offer discounted premiums compared to their competitors. They're able to make a loss on underwriting, but collect large premiums, meaning collect huge cash flows, invest, and make. It's the same thing we're discussing here. So we said, but wait a minute. It's only the big insurance companies that are doing that. What about the mid-sized companies going down? So we said, you know what? We can help them to level up. We can help them to level up. So we approached quite a number of them, and quite a number of them are also our customers. That's why Charles wanted to give you an example, where we now came in as their investment partner, and we helped them to make, now we see our team, to maintain this team is 200 to 300 million. You get it? That's what many companies cannot afford, isn't it? But then we are giving them a quality of a 200, 300 million value team to be able to compete on the same terms as the big insurance companies. and that's where it comes. So I just thought of mentioning that as you're thinking of how to do this, if capacity is an issue, this is one area we can help you. But also just to bring them, the idea of this section as I closed for lunch was to show you if you manage cash well, what will happen? If you don't manage cash well, also what will happen? And these stories, we all know them, isn't it? Nakumat, Uchumi, ARM, Mumias, and many others that I didn't want to bore you with, all of them have one thing in common. They ran into cash crunch. And who was at the center of the cash crunch? I hope that will be not you. So, we are not talking about flowery things here. We are talking about something that if you don't do, your company can end up where? And I don't want your careers, your CVs, to be decorated by a company that went down because of cash crunch.